In this video, I'll be covering key concepts and relationships within the balance of payments segment of the Year 12 Economics course. Specifically, I've put up four dot points which link the content of today's video with the course outline I've provided you at the beginning of the year. So first of all, I'll start off with an overview of the structure of the balance of payments, including the concept of the current account and the capital and financial account. I'll then go through some examples of the double entry accounting system that we use when dealing with the balance of payments. This will be followed by some discussion about the link between the current account balance and the capital and financial account balance. And we'll have some discussion about the investment savings gap and why it leads to a current account deficit before wrapping up with a link covering the link between the income balance and the financial account. In this slide, we can see a flowchart of the balance of payments. So we've covered the balance of payments already, and it is a record of transactions between residents and non-residents, and it can be broken up into two main accounts, so the current account and the capital and financial account. The current account is broken up into the goods and services account and the income account, while the capital and financial account are quite self-explanatory in how they're broken up, both the capital account and the financial account. The key takeaway that I want you all to note is that the sum of the current account and the capital account is 0. So the reason for this is because of, as I've already flagged, the double entry accounting system, where every positive entry is matched with a negative entry of a similar value. So a credit will always be followed by a debit. And that results in the balance of payments balancing, as you would suspect from the name of the balance of payments. So if the current account is in deficit, we would expect the capital and financial account to be in surplus, and vice versa. For Australia's case, traditionally the current account has been in deficit, while the capital and financial account has been in surplus, and we'll cover some reasons for that later in the video. Speaking of the double entry accounting system, I've put up a summary table which outlines or lists out examples of credits and debits which are commonly recorded in the balance of payments, as well as the account in which they fall under. So we'll start from the top and go through the table. So exports of goods and services are recorded as credits. So as we mentioned in class, when you're trying to think about the differences between credits and debits, or what transactions would be a credit and what transactions would be debits, you can think about it as whether there is a flow of money or funds into Australia or out of Australia. So for an export of goods and services, you would expect that Australia would receive some funds or money because Australia is selling or exporting goods overseas. As you're receiving funds, then we would think, or we would label that transaction as a credit. In comparison, if we are importing goods or services, so if we are buying goods or services, what's happening is that we are paying for those goods or services to non-residents, and therefore we would experience an outflow of money. And that's why that we can label an import of goods and services as a debit. So if there's an inflow of money into Australia, generally that's a credit. If there is an outflow of money into Australia, generally that's a debit. So where do export and import transactions fall into when we're talking about the balance of payments? They fall into the current account. and more specifically the goods and services account. So on to the next row, we talk about both income receivable and income payable. So if there are transactions related to the receiving of income by Australians from non-residents, that would be a credit. Again, that mirrors the idea that if we as Australians receive funds or money, we record those as credits in the balance of payments. On the flip side, if there are income that needs to be paid to non-residents, that would be considered a debit, and those two transactions fall into the current account under the income segment. So the next two types of transactions relate to currency. So as we've covered, currency is recorded in the financial account, not in the current account, in the separate financial account. So when we are talking about the export or import of currency, it might seem a bit different to previous examples of exports of goods or services or income, receivables or payables. But what you need to remember is that an export of currency is considered to be a credit. If it's easy for you, you could think of it as an export of a good, because currency can be thought of as a good. So when you export currency, you are sending currency across to another country, and in return, you could be receiving something of value, which in the case of, for example, an import, you could be receiving a pair of sneakers in return. And that's why we would consider an export of currency as a credit. On the other hand, when you import currency, that's considered a debit, because when you're importing currency, you are receiving currency from a non-resident. So you're receiving money, and that typically happens when you are, say for example, exporting a good, and therefore you've got this value attached to that good leaving the country. So you've got the import of currency, which is represented as a debit, and the export of that good, which is represented as a credit. So these transactions related to currency happen in the financial account. The last example of double entry accounting relates to foreign liabilities and assets. So I put down two cases. So if there is an increase in foreign liabilities, then that is recorded as a credit. And if there is an increase in foreign assets, then we record that as a debit. And these two transactions are recorded in the financial account. Now I'm going to go through some examples of transactions which use this double entry accounting system, and they can be seen on the slide above. So 3 examples which we'll go through one at a time. So the first example is Rio Tinto selling $1 million worth of iron ore to China. We know that the export and import of goods and services falls into the current account, and that the export of goods and services is a credit. So we've recorded the $1 million export of iron ore in the credit column. The offsetting entry occurs in the debit column within the capital and financial account. So when you export iron ore, you receive currency in return, and we know that the import of currency is recorded as a debit in the capital and financial account. The second example is of a Japanese resident lending money to Rio Tinto by buying an Australian bond for $5 million. So a bond is a debt instrument which can be used by either firms or governments to borrow money. In this case, we have a firm using a bond to borrow money from a Japanese resident. So the borrowing of money from this Japanese resident is an example of foreign investment. So there's money flowing into Australia from Japan. So we record this inflow or import of currency in the financial account under the debit column. So you've got the negative $5 million, which represents the flow of currency. The flip side of this transaction is the credit entry in the capital and financial account, which records the increase in foreign liabilities of $5 million. So this represents the bond. So the amount that Australia owes to non-residents is referred to as foreign liabilities. And as we have increased our borrowing by $5 million, this is a credit or a positive entry in the capital and financial account. And that's why we've got this plus $5 million in the credit column. So we know that when there is foreign investment in the form of debt, there are interest payments which are linked to the debt. And this is what the third example here tries to capture. So we're talking again about Rio Tinto borrowing money from the Japanese resident, but we're talking specifically about the interest payments Rio Tinto has to pay to that Japanese resident, which relate to that $5 million bond. So one thing to note is that interest payments are linked to the aforementioned $5 million bond does not occur at the same time. So this tends to occur later. So maybe it could happen 6 months in the future or a year after the bond is purchased. But at some point, Rio Tinto will have to pay an interest payment to the Japanese resident who has borrowed, lent the money to Rio Tinto. So when the interest payment needs to be paid, it's recorded in the following way in the balance of payments. So first of all, there is a credit in the capital and financial account of $500,000, which represents the export or outflow of currency out of Australia into Japan. So that represents the money that needs to be paid to the Japanese resident who has lent the $5 million in the form of a bond. The offsetting transaction is a debit of a negative $0.5 million, and that represents an interest payment, and that falls in the current account. And we know that income transactions fall within the income component of the current account. So that's how you record, 3 examples of transactions using the double entry accounting system. So in the next video, I'll talk about the concept of the savings and investment gap and how the current account or transactions in the current account link specifically to the capital and financial account. So I've touched on it briefly in this example, so the third example where we talked about interest payments, but I'll explain the link in more detail in the next video.